wouldn't recommend it to anyone to buy a publicly traded company or entities or anything. I learned a ton, by the way. Talk about jumping into the deep end to your first acquisition. I missed a market opportunity from COVID, for example. There was lots of opportunity to make a lot of money as an entrepreneur that I didn't capitalize on. This downturn was different for me. So when everyone's playing defense and licking their wounds, we went out and played offense, and we've done 8 acquisitions in 2 years and 500 million in pending acquisitions. We also spent 9.2 million to buy, and that is a pretty big domain for us. We're pushing like $250 million valuation, give or take, with revenues exceeding well north of 100 million, 100% bootstrap, yeah.
You run 5 companies right now, personally. What's wrong with you?
Yeah, something like that. We have a litany of different companies, offhand, recruiter.com, beforeyouapply.com, employer.com, and there's a bunch of products underneath those that basically service a bunch of different things, from payroll, background checks, on-demand recruiting. But it's basically like a full suite of solutions for like enterprise and SMB customers. Anything they need to do for their global workforce solutions, including actually vendor management systems as well, which is also a pretty big vertical for us as well. But less sexy, probably less known than most other products we do.
So the 5 that are under that umbrella, it's outsourced HR solutions, essentially, recruiting.
Yeah. So just to take a step back, we started in a service business entirely. And then we saw over the last few years, customer demand for a lot of things that we were already doing, which was vendor management. We have a lot of relationships with other services companies that did other things and niches. And so we ended up buying a vendor management solution called Bounding Jobs. They had raised a lot of money, Greylock and Excel. So they're now part of our company, which is really exciting. It's a new announcement. So that'll basically become our employer.com VMS. We also spent 9.2 million to buy employer.com. And that is a pretty big domain for us.
So you have recruiter.com. You've now just purchased employer.com. You have a vendor management solution that you have as well. That's 3. What are the other businesses that you have under the umbrella?
Good question. So we have beforeyouapply.com, which gives you insights to companies before you apply to them, just how it sounds. And it's a little bit better than looking at Glassdoor or other sites where you're basically going to look at the people that are just really upset on the extreme ends of both spectrums, either really love working there or whatnot. Before You Apply basically allows you to look at the actual managers and how they run those different teams before you actually engage with them in a recruiting process. So it saves a lot of time and energy. So that's one of the solutions. We have vendor management system, as I alluded to, with Bounding Jobs. We have EOR, which is paying global workers anywhere in the world, as well as global contractors. Wow. And there's a few other products underneath there. That's the quick, short version.
I'm going to ask you questions later about recruiter.com and employer.com, because those are just freaking amazing domain names to have. But first, I want to start. You were in recruiting for, let me look here at my notes, Coinbase, 23andMe, Protocol Labs. So you had experience in this space. And one of the things that many entrepreneurs face is they want to become an entrepreneur for a long time, and then there's a trigger moment. There's something where they finally make the jump. You were working at these tech companies, you probably paid well, maybe had some stock, maybe had some equity. When did you leave and why?
To take it back a bit before that, I've always been pretty entrepreneurial. Both my parents are entrepreneurs, usually with SMB, in small businesses. My dad runs a construction company, and my mother ran a small recruiting agency. So grew up in Silicon Valley, and I was surrounded by folks that were really successful entrepreneurs, Steve Wozniak, for example. I went to school with his son. But there's lots of folks like that growing up. Normal being around those folks. And so I started my first business my first company when I was 18, a social geolocation app in college, and then ended up dropping out, starting Job Mobs. So when I was working at these companies, I had already started my company as a consultancy. Job Mobs became recruiter.com and all these things you see today. It just took it to a different level. Great thing I think about working with those tech companies, I saw a bunch of unicorns get developed, 23andMe, Coinbase, Stellar Development Foundation, Protocol Labs, all when they're really small. And same with Scale AI. I don't think it's on there, but was early there, the largest, one of the fastest growing AI companies in the world right now. So you get to see how those companies operate, talent density and everything else in the network. And so now we've brought a lot of those folks that are just amazing operators and even founders into our businesses and scaled those up even further. And we're 100% bootstrapped. So that's a pretty big outcome for us.
How did you go from, hey, I'm a recruiter at these companies, you've got your side hustle. I'm going to call it a side hustle. I get it was your business, right? But you're a recruiter at these companies, you're running, what was the name of it? Job Mobs?
Yeah. Job Mobs, MOBZ.
Why did you get into tech and keep the business on the side?
Well, business was like mainly a consultancy. So we had lots of consultants out already, like myself included, obviously. But we basically did like SWAT team type deployments where we'd help companies scale. So we'd go into a Coinbase and help them scale from like 200 to 1,000. We did the same thing at Consensus and Box.com and a bunch of others. And I'd lead those teams. It actually worked out really well, one, like from a learning perspective, but also I also got equity in other payments from these companies. And it's basically a way to bootstrap. You don't have funding and you don't have a technical background at the time. Raising money would be very difficult to go build certain things. So it was just a hack to get to some next level. And I think at the time too, if I started other software companies that hadn't like panned out as well. So I've always been pretty entrepreneurial. I've had plenty of failures. It looks like it's one big success. But that's not always the case, as you know, Nick. Like it's never that like linear. There's always something, no matter who you are. So
you founded the original company in 2012, and then you were just working with these other companies to sort of do your SWAT approach, where you come in, you help them scale to a certain size, and then you kind of move on to the next one. You're just gathering experience. At what is that correct?
Totally. Yeah. I mean, but also I bootstrapped that by working as a firefighter on the weekends. I worked like 2 or 3 days on, 4 days off, and I bootstrapped my company that way. Steady paychecks. I was working like a madman for a couple of years, like 7 days a week, pretty insane hours, but it worked out obviously in hindsight, and a lot of the cash flow and everything else, and in customer relationships and friends, people I call friends now over the years are all our customers for the same software. So we built those solutions, bought and built these solutions around customer needs that didn't exist in the market. And so we've been able to grab a really large market share there with some amazing customers like world-class brands that folks would definitely know quite well, like, HubSpot, Chipotle, customers like that, large customers of ours. So that's pretty exciting. Like I couldn't have done that when I was, 22 or 3 or 4, 10 years into my career, 35, much easier.
So at what point did you start to expand into this mini holdco, if you will, right? So you've got the job mobs. At what point are you like, all right, first acquisition?
Yeah, totally. So it's funny you mentioned it. Like I didn't even know what a holdco was like 2.5 years ago. No idea. Like completely oblivious. Like didn't care about it. Didn't even think. And then I'm like, we're buying companies, and I saw like people like, oh, are you doing like they're asking me questions about holdcos, and I was like, oh, it's exactly what it is. I guess I didn't even know like what. Didn't even know who Andrew Wilkinson was. Like I knew he was like a designer for the service. Like not until like 6 months ago, and I was like, oh wow, I don't know who anybody in holdco space is, right? So it wasn't design. It was kind of just by accident. But to answer your question, we started doing acquisitions. Like I started exploring like paper LBO situations at the end of 2022. So I knew there was a market inflection point, like change in early mid 2022, and in fact, I called it out. It's pretty unpopular on Twitter and with my own internal team. I thought it was crazy. So.
All right, now's the part of the show where I feel the most uncomfortable, but my therapist says I need to face my fears. So here we are. I've started a newsletter, and I want you to subscribe. And what you're going to get every single week are the aggregated conversations from that week that I have on this podcast with an overview of what their business actually looks like. I'm also going to throw in a review of 1 or 2 businesses that are listed for sale. I'll give you my opinion on whether or not the EBITDA multiple is good, or there's customer concentration, or there's red flags or green flags. And then lastly, I'm going to give you one piece of actionable advice every single week on how to buy your first business. So click the link below, subscribe to my newsletter, and let's get back into the show.
But we sat on a bunch of cash, didn't raise pay. Like we basically knew there was some storm coming based on like, we have a ton of data right around jobs and also hiring. So when hiring goes down and job postings go down, I can see a linear trend of what's going to happen before anyone else. So that combined with previous like downturn experience, I think basically pulled the plug on spend, and we sat on cash. So basically by the end of 2022, I knew I was going to do something with, I thought the market opportunity from like COVID, for example, I had missed. I thought there was lots of opportunity to make a lot of money as an entrepreneur that I didn't capitalize on that you could have during that time frame. And I didn't want to make sure that this downturn was different for me, that I would go capitalize. So when everyone's playing defense and licking their wounds, we went out and played offense, and we've done 8 acquisitions in 2 years. And
jeez, man,
we've got 500 million in pending acquisitions right now.
500 million in pending acquisitions?
Pending acquisitions moving toward, they're in LOI, they're going towards definitive agreements. That is what's happening. Yeah.
Are you still a firefighter too?
I'm definitely not a firefighter. At home, I'm the CEO and firefighter. At work, virtually, and at home, rounding up kids, but not anymore, unfortunately. It's a lot of fun.
you've got job mobs, 2020. Give me an idea before you started sitting on cash. Like, what was the size of the company? Like, how many employees did you have? Can you give me like top line revenue?
Within my best, without pulling up like the actual data, I think it's like 2022, we probably would have finished the year around 7 million, 8 million, somewhere in that range, I guess. That's my guess.
You're good size. I mean, for a services business, that's freaking actually hard when you're in that like
Totally,
5 to
it's
10.
not easy. That's like 40 people, 50 people, something like 50 people is my guess.
So you make the decision, all right, I'm going to start sitting on some cash, which was very smart. Job mobs ends up becoming recruiter.com. Was recruiter.com the first acquisition that you made?
Yeah, it's pretty crazy too, the story there. They're a public company, so this isn't like some trivial acquisition for your first one. Like, you'd have to be insane. I wouldn't recommend it to anyone to do attempts to buy a publicly traded company or entities or anything. I learned a ton, by the way, like talk about jumping into the deep end to your first acquisition. So we did the first acquisition. That was mainly just carving out their services business. That was the first one that's at least public. We did some other smaller acquisitions. They're like just acqui-hire type things. But we did that in March of 23. And then we closed a bigger deal with them in August of 2023, which basically take a lot of the brand assets around recruiter.com private. And that was, that took us a year and a half to close. I think I just closed this last August. So
what happened? Why were they in trouble? What changed for them?
I don't know their internal circumstances, so I don't want to speak to like those particularly, but I do know that like a lot of businesses, talking generally here, like across the entire HR tech space, have been caught off guard with like the macro trend going from like an insane uptrend, right, of like hiring in 2022, like the best it's ever been, to the worst it's ever been. Like I had a CEO mention like this week, they mentioned that like this is worse than 07, 08, 09, they're around then, and like this is a worse downturn for tech hiring at least than it was then. And so that kind of gives you an idea of the landscape, how quickly things shifted. And so I think a lot of companies, even, we've acquired good companies. We have a few others, obviously pending, as I mentioned, but we've made a bunch of other offers. I've talked to hundreds of companies in the last 2 years, and every one of them, except for us, is basically declining in revenue. Like the revenue's going down, customers are churning, and it's just kind of a bleeding, death by 1,000 cuts. And so it's not like it's not that founders are doing anything wrong, or, if the companies are doing anything wrong. It's just simply a macroeconomic trend.
Recruiter.com, were they doing what you're doing? Were they a competitor to you, or were they doing something totally different and you've just repurposed the brand into what you do now?
At the time, yeah, they're definitely doing something similar. That's why we acquired some of their services businesses. They were doing, recruiting as a service, and they've really good, really beautiful brand, millions of followers on social media, the largest LinkedIn in the world. Yeah, it's a beautiful, beautiful company, and so one of the first groups I joined on LinkedIn. So really good, like legacy brand and everything else, and that kind of unlocked everything. So if I'm a small business owner, let's say like talking like your audience, like folks that are building companies, I think the biggest thing that unlocked for us and allowed us to go do all of these other acquisitions, because the brand and image of that made us look a lot bigger, right? We're only doing 7 million. We're doing a lot more revenue now. But the point being is that at the time, we were relatively small. Yeah, we had cash. We're sitting on cash. We had good margins, but it allowed it and unlocked all these other things that we've done to date. It made a huge impact. And so now when you look at our current revenue, it's, mostly ARR, and we're able to go punch way above our weight. And I think that's just a big thing. So like if I was to spend money as an entrepreneur, like I would go buy an employer.com or recruiter.com as early as possible and get that brand and that like image. Like when employer.com, for example, before we bought it, didn't exist. But if you went and told your mom or dad, hey, I own employer.com, I bet they would say, I know that. I know of them, even though it didn't exist a month ago. And that's the point. You spend the money because you get the image, right? You get the brand, and that's worth, that's an enterprise customer. You might spend $500,000, $2 million on it. Obviously, it's hard to get that cash, but let's say you have it. That return, the ROI on that is huge. You might get an enterprise customer who pays you $500,000 a year. And for me, that's worth every single dollar.
2022, you're sitting on cash, you're a $7 million company, and you end up acquiring recruiter.com. They're publicly traded. How did you even get in the room with them? How did you even know that they were for sale? Like, how did you even finance it or afford to purchase them? Like, there are just so many questions that come up for me because, I'm a small business owner. I would never be able to go to like, I don't know, fashion.com and be like, hey, could I purchase you? How did that whole story happen?
Yeah, so there's many facets, like parts to it. My best like reconstruction of it is we won like an award for like top RPO company, it's like HRO today at the end of 2022, which is like big in our niche vertical
What's
space.
RPO? I don't know what that means. Sorry.
Yes, yeah, I'm using jargon. So like, ask me if you don't know. It's not common knowledge. Recruitment process outsourcing, like that SWAT team building out of companies, long term or short term. And so that kind of got us on the map. I'd already met with those folks previously, and they had some other like paths forward they were looking at, and I kind of talked about maybe but I met them and we'd had conversations to try to get something done, like a partnership or something similar previously to March 2023, and they had some other things they were exploring, and so we just got to the right place at the right time. Right, the whole market came down, and all basically like I think our internal like framework for the last 2 years is we pretty much are the market. So like when like every founder you talk to when you're doing M&A, will say they have another offer. Right now, that is maybe true, but not in the sense that you'd think. It's all really like there is no one else making like fair offers.
Well, I mean, so as an outsider, I'm like, all right, you're a $7 million company. They're publicly traded. Now, there are lots of publicly traded companies whose market cap is not $7 million, right? They're micro caps and they're very small. But it just has the air of, oh, they're much bigger. Recruiting.com is much bigger than Jesse's company, right? Why not go to Indeed or Glassdoor or Monster or any other job servicing company and sell to like a larger brand like that? Like, how did you even get to the space where they weren't even entertaining other offers? All of a sudden you're talking to them. Were they a lot bigger than you, or were they just not as big as everyone thought and they went public to, have a liquidity event for the people who founded it?
I have no idea about the reasons for going like public. But I can tell you why we win a lot of acquisition deals, like empirically, like compared to Indeed or Glassdoor, which are both lots of friends at both companies, good companies. Just to clarify, and I think this is true of all like large strategics. They move really slow. I think so. Like when you have a big financial turn, and a lot of companies were over 21, 22, and this is not specific to recruiter.com, just general statements. They were basically like earning, $1 to earn 50 cents across companies, right? Because growth at all costs was what the market was rewarding across both the private and public sector for these companies of all types. And so I think that when that turned in, let's say, early 2023, early 2022, a lot of folks were caught off guard. And so what's happened is now you have a secular decline. So like the Indeeds and Glassdoors of the world aren't buying companies. They're going to move really slow, especially when they have decreasing cash flows on their cash sheet, right? And increasing burn, decreasing revenue. I talk about Glassdoor and Indeed, right? Like, or revenue growth flat, right? So basically it creates a situation where like those companies aren't acquiring. If they are, it's going to take 6 months. And so what we've done a really good job of is like, we'll pay, like we tell founders, and why we've closed a lot of deals, we'll close in 30 days. We're going to make, certain things like stringent on terms so that we don't get screwed since we're moving so quickly. But like, that's the difference is like, one, if we've never done a deal where we've told somebody, hey, we're going to do X, Y, and Z or give you this price and backed out. So it's a reputational thing. And then two, there's no, like, that's the big thing with like PE, right? You're going to get retraded on. It's almost 90% guaranteed the end of whatever process they put you through. And after you spent $250,000 on lawyers, finance folks, they're going to say, hey, by the way, Nick, this is your real offer. Take it or leave it. That's after you've told all your friends, family. So that's just, it's not a good experience you've thought about from sales process. So what I do is I try to educate founders and say, hey, this is what it is. This is what we're giving you. This is what your private equity offer is going to look like. This is why they're doing it. And this is what they're going to give you. And most of the time I'm right. And even the founders that do go with the private equity offer usually come back to us and say, you know what? If you're still interested, we'll buy. And that's kind of the secret sauce of how we do deals and why we win deals, not specific to just recruiter.com, but all deals that we do within a certain degree of plus or minus on some different terms.
Can you give me an idea how big was the recruiter.com deal?
How big? I mean, well, I think the bigger piece, like they have 10% of our cap table preferred shares. So it's a pretty, like, basically for being bootstrapped, it's pretty significant. They still publicly trade, I think, on the secondary market. So I don't want to share anything, but I think that is a pretty valuable outcome for them, honestly. So like if you compare it to our valuation today, I think it's a well into the 8 figures deal, in my opinion.
That's a sophisticated transaction, man.
Like definitely, we paid cash. I think the big thing too, like we paid $1.8 million at close, and we paid some stuff along the way as well. So it was multifaceted, very sophisticated and complex, I'd say, because of the time it takes, right? Just to get it's nothing to do with us because we're private, but buying anything that large or taking that much of an asset from a pubco, you have all the regulators and everything else that need to approve all of that. And so it just takes a very long time. Wouldn't be my first choice if I was doing acquisition again in terms of just the speed at which I being moved generally it's much slower, but good outcome, I think, for everyone, all things considered at the end of the day on all sides. So.
Okay. So where you were $7 million sitting in 2022, can you give me an idea of size and scale of your companies now?
$250 million valuation, give or take, with revenues exceeding pretty large number. I don't want to say the exact revenue number yet, because it's depending on when this is even released, honestly. But I think I'm happy to share it on some of the retweets or whatever of this. I can put the updated one, but it's gonna be a lot. We'll be pushing well north of 100 million revenue this year, and that's 99% SaaS, right?
And that's all bootstrap.
100% bootstrap, yeah.
Dude, that I don't think people will fully appreciate how hard that is to do.
So it's pretty insane, especially going from services, pivoting 100% into SaaS is nearly impossibility. I don't think I can replicate it myself. I joke with my team all the time. I'm if I just quit tomorrow, not that I am, but and just tried to replicate what we've done, couldn't do it. It would take me a while, even with money, right? Even with resourcing and networking, it would be very uphill battle to get everything put.
Do you feel like that strategy that you had, which was, or the thesis that you've had, which is all right, premium domain names, recruiter.com, employer.com. So I'll give you an example. Chris, my business partner, and I own cofounders.com. It's not recruiter.com, right? But it's cofounders.com. And we, at the time, I paid for it $65,000. And I was like, I don't know, should I pull the trigger? And looking back,
I'll pay at least 100 right now. So if you we can write up a few right now, I'll give you 100 grand for it. But 120, you can do 130, you can double your money. I'll even give you some equity in my
okay. All right.
Can execute this right now live on the podcast, Nick. It's just totally unscripted. So it's great.
This podcast is just turning into Shark Tank. Jesse Sharks. Today I am seeking but you would think, yes, that strategy, premium domain names, has absolutely paid off for you.
Yeah, definitely. Definitely do it again. I think with any business, I would buy or start or do. In fact, there's some cool folks I've met that do brokering of it, and so I'm always looking at domains depending on what we're doing. We're looking at some others right now for different verticals we're going after. So definitely be an announcement in the next probably 6 to 12 months for another premium. Founders.com, I pay a lot of money for it. A lot.
Dude, Founders.com would be.
Yeah, not saying co-founders is it's good. It's very good, but.
I'm stoked that we got co-founders for 65 grand. I think it's a great, if I can get founders.com for 65 grand, freaking sign me up. Recruiter.com is at least an 8-figure domain name. Then you got employer.com, freaking $9.2 million that you bought for it. Do you have a domain sickness like my business partner, Chris Kerner, does? Because legitimately we spend like $5,000 a year just on registering the domains that he has that we don't even use.
I have probably 100 domains across. So it's definitely not $5,000 worth a year. I think it's what is that? 100 times $12 or something, $1,200. So something like that. He's got me beat by a couple hundred domains, it sounds like. But yeah, a lot of it's a mix of things. I own recruiting and HR.com as well. Just things that would make sense, right? So basically, things that tie into our industry. So, and all the other ancillary ones .nets, .cos, all of those main domains we're focused on.
Okay, do you recoil as badly as I do or Chris does at a .net versus a .com?
Yeah, it's just not the same.
It's not the same, right?
I wouldn't pay a ton of money for that. I need basically also think about your ideal customer profile too, what you're doing, how I would suggest it is somewhat subjective. Most of my customers are 40 to 60 years old, and generally .com is going to domain name is going to be really relevant to those folks. And so but if I was selling to it'd be very different, right? I'd probably go social media, and more presence there as opposed to traditional web sales for enterprise. So I think it really depends on your your ideal customer profile. So I wouldn't say overarching statement of that. I think gives you brand authority too, even if you're selling like a course or something. Like, who's the guy that was selling like, what was it, courses.com? I forget his name. Like, anyways, it doesn't matter. Don't need to give him a plug. But like, yeah, was it consulting.com? The consulting.com guy. I have to look it up.
Yeah, that's ringing a vague bell. But yeah.
He spent much money on consulting.com, but I think it works for a litany of reasons.
Have you been able to measure like the return on these premium domains? Like, obviously there's a brand component to it of, hey, I own recruiter.com, right? Oh, wow, Jesse must be legit, right? But for you, I don't know. Is there a way you can measure, oh, this is how many searches employer.com was getting per month, and now I'm able to convert all of that traffic because it what didn't exist before and it exists now? Like, do you look at it like that, or is it more of a, no, it establishes me, it gives me credibility, and now off of that credibility, I'm able to build?
The answer is definitely, we've done a bunch of stuff. I think the simple way to put it, and this has probably like never been done, we have an infinite IRR. And so the reason is we've bought all of these deals in the structure in which we put none of our own capital at risk for many of these deals, in my opinion, where our IRR is literally infinite. So that's how good deals we've done are, in my opinion. So that makes it pretty much a no-lose situation from our perspective, but would make Berkshire jealous in their original heyday. So
this is my last question that we can riff on. Many people will look at these premium domain names and might have the strategy of like, oh yeah, I need recruiter.com. Whatever the price is, I'll pay it, and I'll go raise a fund and I'll pay for it. But in hearing you describe the way that you've purchased these, there's creative deal structuring, like with them. How do you think about that? Like, obviously you want the domain, but also you're still being creative with it. What recommendations do you give to people who are trying not just replicate your exact strategy, but replicate the strategy of go big, buy the big assets, but don't necessarily come out of pocket a ton of cash?
In ours, what applies for us might not apply to others, but I think the general overarching thing is we get pretty creative with deal structuring. So let's just say that like I'm buying your business, Nick, and let's say it does $1 million EBITDA, right? It's just simple services business, let's say, and let's say we settle on like 4x, right? 4x EBITDA for whatever that business is, let's say. Well, you can do like, let's say you have operating like working capital needs, right? $1 million, let's say, that's flowing through the business. So now I can raise debt attached to the business in a lot of cases, assuming at some scale, right? Obviously, I've been pretty vocal about not liking SBA loans for the personal and like liability of it. Very, very vocal and against it online because I think that it is not great. But nonetheless,
I'm pissed I just found that out 30 minutes into our conversations because I would freaking love to debate you on that one, but keep going.
Yeah. So just remember, my carte blanche statement for that is infinite IRR. That's all I would say to you. So it's not the case with SBA. So you basically can do a paper LBO, right? Like, so you basically do a founder like note on that, right? So like it's simple structures. Hey, we're going to roll $1 million equity, $1 million seller note, and we're going to give you like an earnout of $2 million. Like that'd be a simple structure, like a very basic one.
Yeah.
Obviously, you're like, okay, well, there's no cash flows. Well, in theory, but you should be having working capital that's flowing through the business, making like a lot of cash. So I think deals like that in this SMB space exist everywhere right now. Boomers wanting to retire. To give you some statistics here, this is like really interesting data. I nerd out about this stuff. I read 10Ks. I look at data reports for this stuff all the time. The big thing is like what is like 90% of businesses fail in the first 10 years. Of those businesses, only 20% of them end up selling. So like even if you survive 10 years as a business, only a small subset of them actually sell. That means that like out of the companies that make it 10 years, the very small select few, only 1 in 5 are actually selling, which means the other 4 out of those 5 are just shutting down. And so if I wanted to go, like I've told a lot of my friends and family, I'm like, look, I would just go buy a bunch of like local businesses, roll up 2 or 3 of them, do all seller financing. There's a bunch of older generation like boomers that want to wind down their business, and they're just going to shut it down. And all that knowledge, all those customers are gone. Like you can basically go get seller financing and earn out and maybe some rolled equity, and you can just buy these businesses literally for $0 down. That's it. Like that's, you could do that all over the country, like everywhere. I could do that like in my blindfolded, like it's there for everyone that's listening to this if you structure it correctly and you keep your deal costs down for lawyers and accountants. So
So 2 comments on that. First one is any business that I've bought that was over $100,000 transaction price, I have never paid all cash down. Or financed everything. There's always been a seller note, something forgivable, something rolled, some creative portion of equity in the deal structure. So any deal over $100,000 has always, for me, had a component of a seller note or something creative involved. Smaller deals than that, just to get it done quickly and like not have the headache, I've paid cash. But most of the time, not most of the time, every time over $100,000, there's something creative. But the second piece is Chris and we recorded a podcast this morning and we were talking about this. Have you ever heard of Pro's Closet? Chris likened it to like CarMax, except for road bikes. Like, the guys who are in the spandex and riding the bikes on the road. Yeah, those type of bikes. So it's like a resale market. And they went out of business. They raised a bunch of money and they went out of business. And he reached out to the CEO and was like, hey, I saw you guys shut down. I'd like to buy your email list. And he was like, oh, we just agreed to terms and we just sold that to somebody else. But it's something like people don't even think about. Hey, what's happening to that customer list? What's happening to the IP? What's happening to whatever other assets you have? They're not thinking creatively. They're thinking, oh, I got to pay all cash, or I just got to come in top dollar. And I love that structure that you just laid out.
That's a great way to, if you don't have money. Other than that's why I'm like against SBA loans, right? So if we want to debate this, like I would start there. And then if you move up and you have a track record and you feel confident making bets, like it should be asymmetrical upside and you should feel very confident about like taking, because that, money against your own personal liability to then, grow that business or businesses that you're buying. So it's a much safer way to start, I think. And I think with your point, because we've done this, there's a lot of companies that are just winding down and there's tons of IP and assets there that you could go buy for very like friendly deals. Right now, especially that, companies that just, shut down, to your point. We've done this a few times that are like deals we don't even announce where we'll just buy up a code-based customer list, whatever it is. And you can get stuff. And also like there's actually auction houses for this too. So like the other piece that most people aren't aware of is that like VCs and private equity firms will have auctions of companies that are winding down and you can buy up ARR. Like there's a company who's doing like 150K ARR. We could have bought it for 200K. Like 200K, 200K is it's literally 100% cash on cash return. And probably run it with no people. I didn't have bandwidth to do it because we're doing larger deals, so it's not worth like the one like trade off is that it takes just as long to do a small deal as a large deal. Like, literally the same process. It doesn't change anything, so it's sometimes actually harder on the smaller deals for a variety of reasons, mainly educating the founders on the terms. But those deals are literally everywhere right now, and so like across every single vertical. Yeah. So
when you just described tech deals, and I know you said this earlier, but those types of deals are all over the country. Like they don't have to be tech deals. They could be the local electrician that just shut down. They could be the local pizza company. They could be like whoever it is that just shut down. They've got a customer list. They've got a history of people who have come in and out of their business over a period of time. You can go and approach them and say, what are you doing with that list? I'd love to have it. There is value there to be captured if you're being proactive on it. So like, I wouldn't listen to this and think like, oh, that's unattainable. Jesse's talking to PE and venture capitalists and he has access. No.
I'll give you another nugget. Like one of the things that one of the roll-ups I'm going to be working on the next year or two is all like construction roll-ups for commercial construction, build outs, like electrical grid stuff, mainly to do government contracting work. But basically there's a lack of general labor like happening in the construction industry, right? There's a huge like surplus demand, right? Building out old infrastructure. So it's not just tech that this applies to. This applies to every single industry in America, right? To your point, it could be your local pool companies to pool cleaning companies to bug spraying companies, whoever, all of it is relevant. So,
well, I love the approach that even though you have money, you're not being lazy with it. And you're not like, oh, cool, good deal. Okay, here's cash. Oh, cool. Yeah, we'll pay. You know what? Oh, you want 1 million? We'll pay you 1.2 and we'll close quickly. Like you're still being stringent with how you purchase these things and creative and having them roll some seller equity like that. I just admire that so much because it is so easy once you have a win or once you have some cash to kind of, okay, we can be a little flexible here and get out and get over your skis. So kudos to you for that. Here's the last question. Well, before I ask the last question, where's the best place for people to come find you, Jesse?
Yeah, Jesse, my first last name, Jesse Tinsley. It's on Twitter or LinkedIn. I'm just there the most and generally pretty active. So love to connect with you.
Here's my last question. let's say outside of recruiting, if you were starting over and maybe even you're not even in Silicon Valley, what space are you like the most excited about, or where would you go to start your wealth building life 10 years ago?
Today, I would. It's actually what I'm partially be working on with some of these roll-ups. It's all things rebuilding like U.S. infrastructure in electrical systems. That's something that's going to be completely redone in the next 10, 20 years, not only for like AGI and AI, but because of new power systems. So I think anything that touches that is going to be a massive opportunity, whether it be the tech, the construction, the supplies, the materials, anything that touches that supply chain is going to be a massive multi-trillion-dollar opportunity, like TAM, over the next 20 years. So I think that is a absolute gold mine. If I was just to even be like the concrete supply company, like that would be a big opportunity. That's where I would start, honestly.